Hello, hi everyone. This is Arun from Investing Gurukul. So from today onwards, we are planning to do some commodity series videos. So this is the video number one of this series. So the intention here is to look at the commodity space and its implications on day-to-day life and also the investment space. So yeah, starting first off, we need to understand how does the commodity cycle look like. So before we begin, there's a disclaimer. So do your own due diligence, and this is not an investment advice. It's more of, mainly for learning purposes. So commodity cycles. So commodities are essentially like, things like the oil or like agricultural products, your wheat, your rice, your sugar, cotton. All these are commodities. Even your precious metals like gold, silver, or the base metals like copper, zinc. All these are commodities. The commodities are used, say for example, if you take an industry, they could use a commodity as a raw material, and then they could produce their goods out of it. Or the commodity itself could be a production. So in case of a mine, let's say a gold mine or a silver mine or like a zinc producer, they could mine and produce that commodity itself, and that becomes the end product, right? So the commodities could be a raw materials or it could be a end product. These feed into different stages of the industrial cycle, and that affects the end product that that we consume. So understanding how the commodity pricing works is important to understand how the earnings of the companies, how does it affect the earnings or how does it affect your livelihood. So here, what we see globally is that commodities go through a cycle. So you could have a 10 to 20 year bull cycle of commodities where inflation keeps on going high, the commodity prices keeps on going high, and then at some point it stops and then it again kind of retraces back, wherein the commodity loses value and then it loses the price potential, and you will see a bearish cycle. So again the bearish cycle goes on for another 8 to 10 years. So depending on how this works, each industry gets affected positively or negatively. So here in this case you will see the mostly these are all four different areas: oil, livestock, metals, and agricultural products. But then, on a macro trend, these will flow in a bullish flow together, and also like in a bearish flow together. Like as you can see, during the 1930s, during the Great Depression, so you can see that there was a big dip, and then the inflation and the other things picked up until 1950s. There was a big commodity cycle. And then for the next 20 years, from 1950 to 1970, you can see that it went down again. And then again, it picked up during the 1970s and so on. So this essentially, we are in we go through these cycles for every 10 to 20 years, one way and then the other way. So this is like a split of the bull cycle and the bearish cycle. So you can see that the last bull cycle happened between 1999 and 2008. And then while the bear cycle happened between 2008 and 2020. Right now, I think we are already in a bull cycle beginning from 2020 onwards. So like the last three bull cycles, if you see, so 1970 to 79, the bull cycle happened because of the oil price shocks. And then like there was Cold War tensions, industrialization, and so on. And so what happened was the energy prices went up, and also the gold, went through a huge upcycle. So there was stagflation during this time. Stagflation is, your inflation is up, but your economy is down. Then there were currency devaluations that happened. So it was a 10-year period of huge bull cycle. Then subsequently there was bearish cycle, and then followed another bull cycle in 1999 and 2008. So this was because of the Chinese demand. So they needed raw materials for their infrastructure and everything. So it started a huge cycle of demand, and also uh, it coincided with the weakish US dollar, and you could see that the um, the copper prices or a steel price or energy prices went high. So this was purely the 99 and 2008 was purely driven by the Chinese demand. And then 2020 onwards, what we are seeing is post-pandemic recovery, where there was a huge deflation, and then like the post-pandemic recovery happened, and then a lot of money was pumped into the system that caused the inflation to go up. And today we are in a cycle of rate cuts across the world, right? So whether it is US or India or wherever, we are seeing the rate cuts happen, and then the dollar is again like in the 70s. The dollar is now going through a devaluation. Like in the last 3 weeks, dollar has lost around 10% of its value, right? So right now we are actually in some kind of a bull cycle. And this is a graph of how the commodity performs versus the S&P index, which is the American US index. So you can see that every um, peak of the bull cycle is characterized by some kind of a crisis. So you can see that there was an oil crisis, then there was like during the Gulf War or during the financial crisis. So this is kind of also reflected in the gold prices, right? So right now you see the gold is at all-time highs today, $3,400, per ounce. So this is like these are all the patterns that you see. And what happens to the Nifty? So what usually happens in a commodity bull cycle is your earnings get affected because if your cost of uh, production becomes higher and higher, your earnings get affected. So your general equity market go through a lull period. So what interesting thing we can also see is, can we see something around the Nifty and gold? So I did a chart on this. So where you can see that this is a Nifty to gold ratio. So that means when this prices goes high, it's because probably the Nifty is higher and the gold is lower. And then when it comes down, Nifty and the gold, gold is getting higher and the Nifty is like starting a correction. So the interesting part is here, if you see between 2000 to 2003, you can see that this ratio dropped. And in the same way, between 2008 and 2012 here, the ratio dropped. And then again during 2018 and 2021 it dropped. So if we can switch back to the um, you know to Nifty charts, so what we can see here is between so first is between if you see between 2008 when this ratio hit high, so during this period it was a flattish growth till 2011. You can see that it was only 2011 end, it was only 28% degrowth that has happened in the Nifty. In the same way, when you can see the next one is like, or even if you go back, so 2000 to 2003, right? Go to the Nifty here, go to the 2003 period, which is starting here to here, right? So if I do a measurement, so I can see that in this 3-year period, Nifty lost 50% of its value. So over this 3-year period, so let's say if you invested at top 1830 Nifty, by the end of the 3-year period, it was still hanging around 915, right? So in the same way, here, between 2008 and 2011, so you can see that 2008 peak to 2011, which is somewhere here. you can see that overall it went down a lot, but then it regained some more, but then it again became, again went down. So it's like around 28% on a 3-year period, negative was the return. So you could have a period of ups and downs, but essentially it was down. So that is what this tells us. And again, let's say between 2018, September 2018 to May 2020. So you can see from here, September 2018 to May 2020. So this was around like a 1.5 year period where Nifty lost 37%. Okay. So now here we are. So you can see that we have been trying to go up and down, but then essentially here during September 2024, this ratio has broken down. So which essentially means that from it could, what could happen here is, what could happen here is that this ratio goes down and then, it spends some time here and then it could recover, right? But then if you look at the time period of this, but if you look at the time period of this could be around say 1 to 2 years. So potentially we could have 1 to 2 years of this kind of ratio being down here, or the alternate scenario is, we could come down here and then we go back here. But even then, we are talking about some time lag here, right? So what this says to me is that when this ratio goes down and spends time around this trend line, the Nifty returns are going to be affected in general. And what do we see here in the Nifty? So here, when this ratio broke down during October, where are we in the Nifty in the October? We exactly hit the peak here. You can see that exactly Nifty hit the peak around this time, and we have only dropped 18%. So for me, if this trend is to continue here, so that means over the next 1 to 2 years, we could have more drop in the Nifty and it could be a more bearish market. But then it doesn't mean that it will always be, going down and down. You could have periods like down and then up and then down again. But then essentially the Nifty returns over the next 1 to 2 year period could be muted or low. So so what does it say, going back to the presentation here, what does it say for us? So what does it say? For me, it's like commodities will still do well, okay? But then because the commodities are doing well, your earnings are going to be flat. Uh, and this means that the Nifty could be flat or down. Index funds in general, if you just put a mid cap index or a large cap index or a small cap index, it may not do well over this 1 to 2 year period. So it essentially becomes a stock pickers market. So only like a selective stocks do well, whichever stocks which has momentum or which has positive influence from these commodities will probably do well, while those others will lag or like remain flattish. So so this kind of gives you idea of how commodities helps, or like to understand where you should be placed. So what we will do from here on is like we will look at each and every commodity. Say we'll probably the next one we'll do is a gold and a silver, and followed by copper, zinc, and we'll also do some on sugar and cotton. We'll do each commodity by commodity. We'll look at the current market trends. How does it look for the next 1 to 2 years? And then is there anything that we can learn from the past? And also, what are the stocks which are affected positive or negative by those? So yeah, thanks for listening in, and hope you come back here again.